Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, November 1st, 2022. As we kick off the first trading day of the month here, remember we are now just outside of 24 hours to the big, much anticipated FOMC rate announcement. Consensus seems to be baked in the cake, a 3/4 point rate hike, but the big thing will be, what does the Fed say after that? What do they talk about? Are they going to maybe back off the previous expectation for another 3/4 point hike at the next December meeting? Are they going to pause, wait and see, because it does take time for rate hikes to kind of work their way into the economy and slow things down? Again, that's what the market will be looking for. We can sit here and try to guess all day long. We all have our thoughts or guesses. Maybe some of us do, maybe some don't. The best thing to do, is let the market show its hand. We're at a pretty critical technical juncture. What I'm going to do in this video is the point of this video is really to go over commodities, or what I call the bane of Powell. Commodity prices are really our best real-time indicator of inflation. They're not the only thing that drives up the rate of inflation, but they are the ones that can be priced instantaneous, second by second, throughout the trading day, and many of those even into the night as the futures trade. We know exactly what the commodities are doing, and oil and natural gas are obviously two of the biggest ones that have some of the biggest impact on inflation. But food, building materials, copper, lumber, etc., all play into the inflation numbers. And so I'm going to go over that as both trade ideas as well as kind of bigger picture to where we are and where we might be going. That's the important thing. All right, so before I do that and get into the commodities, let's just do a brief update on the equity markets. As I mentioned, we had some major downtrend lines, and we still do, on the S&P 500 and NASDAQ 100 futures. This is NQ, 60-minute chart. There's our primary downtrend line. I'll zoom in here for you in a second. But as I said, I expected a reaction off there. Actually, on both the last two hits, both of that we had. So we had tradable pullbacks. I'm in active trading mode this week. There are some swing trade ideas that I'll share with you, and some that I put on this week. Added to that wheat trade. I took some coffee today. I took, I've been trading natural gas, lumber this week. And I'll go over those ideas here in a second, but I just want to point out this is a primary downtrend line. So, in recent videos I said I expected some choppiness this week leading up to the Fed, but also a downward bias because of two things. Number one, the technicals, first and foremost, but also the fact we've had a healthy rise off the bottom, and a lot of this, the technical, it was technically induced with the positive divergence, the divergent low on this 60-minute chart, as well as the daily and even the weekly chart. So that part of it I attribute 100%. The technical case was made, but most of the bobbleheads that come out and on the media, and whether it's in print or on TV, they cite the fundamental causes, and the media will always try to assign a cause to a rally, as well a lot of these so-called experts, they march out, and that was the consensus seems to be a perceived pivot, or an anticipated pivot, if you will, by the Fed. Again, not a pivot that they're going to go from hiking rates to all of a sudden cutting rates, just that they're going to pivot a less hawkish in rhetoric, because up until recent comments coming out of the Fed in the last few months, they're kind of in that blackout period now, as they always are right before a Fed meeting. But up until then, it was expect 3/4 point rate hikes coming. That was baked in the cake. Probably get the 3/4 point tomorrow. Previously it was 3/4 in December. Now the odds are kind of shifting towards 50 basis points. So that's the pivot, just a softening in the hawkish outlook. And again, what they say tomorrow, whether they are going to come out and be specific or just keep it vague, data dependent, we'll see where things go. That's what the market's looking for. Now, if the market, for some reason, if the Fed continues to jawbone and talk the tough talk about fighting inflation and not letting off the letting the foot off the brakes, then that's not going to be good for the market. But again, we'll see what the market does. The technical case is there, and if the market's going to go higher, what the market will do is that when it wants to rally, good news is taken as good news, and bad news is dismissed or ignored, or even sometimes spun around to be good news. And vice versa when the market wants to go down. So, all right, let me get into the commodities before I do here. So that's the primary trend line. It's provided some nice pullback trades lately. This is zoomed in now. You can see we've been bouncing on it 1, 2, 3, and there was our pullback. And then today we had in the futures last night just an ever so brief overshoot. You had a beautiful uptrend line that shows down to the 10-minute chart, 5-minute charts, and that triggered the breakdown. So what you have even better than a rejection off the trend line here is a slight pop followed by a failure, and that is what we call a bull trap or a false breakout. Now, what bull in their right mind would take a breakout the day before the Fed? I'd love to meet him. Because I don't know. It's just obviously me being a little sarcastic. But you don't take breakouts that occur, especially on an overextended security right in front of the Fed announcement. And so that breakout failed. And the reason that's more bearish than just another rejection off the trend line is, again, because it's what we call a bull trap. Longs pile in, shorts get squeezed out, so it lowers short interest, sucks in some new traders on the long side, and then those traders get stopped out. And so that's what you have here. Right now we're at support or a hair below it, and that's probably it for today. Although who knows? I told you we're markets in profit taking mode. Rightfully so. Anyone that bought the lows or anywhere in between here should be taking profits. It's a prudent thing to do. Why take the risk, whether you're long or short? Right now, from a swing or trend position, who wants to go heavy into the Fed? So obviously, it stands without reason after a rally like this. Let me measure it out for you real quick. We know that the Dow had its biggest rally in many years or decades, but the Nasdaq's been lagging relative to the Dow. And from the bottom to the top right here, it was about a 12% rally. So it stands to reason that a 12% rally in the Nasdaq 100, and even better in the S&P, is going to clear out a lot of short interest. Shorts at what I call JCL, Johnny Come Lately, shorts that piled in here, or remember that was also a bear trap, false breakdown. And so those shorts were squeezed out, short interest has been reduced, and a lot of longs, probably especially active traders, even some investors may have piled in there, and they're taking profits in front of the FOMC meeting. This, I think, will be a little overshoot. Will probably pop up now. It's a little bit overdone for today. The pullback, we're down, well, not too bad, 1%, 1.1. I'll get to that in a second. But okay, I'm going all over the place here, and again, my point is to get to commodities, but let me show you what we have finally. We didn't have it yesterday. Yesterday, as I pointed out, we had negative divergence on the S&P 500 60-minute chart, right? We didn't have it on the Nasdaq 100. Now we do because of this pop in the futures into last night, early today. That gave us a marginal new high, higher high with lower highs on the indicators, aka negative divergence. The last time we had negative divergence on the 60-minute chart, this is what the market did, or the Nasdaq 100 did. The time before that was right here. That's what you got there. So 60-minute charts, my favorite swing trading time frame, and so far, that was good for a pullback. And if history is a guide, maybe we'll get some more. But again, you can't bet it too hard. The Fed's tomorrow. This thing could pan out. Maybe that's all we get. Who knows what's going to happen between now and tomorrow? We're going to, something different will happen here. But then what you want to look out for is a solid break above the trend line tomorrow. And if you get that, then you still have major resistance up here at about 11,785 to contend with. Let me just jump over to ES because it's going to take forever if I don't get away from the markets and into those commodities now. Same thing on ES. Same exact thing, except we already had negative divergence yesterday. There's our primary downtrend line that comes off the mid-August highs right there. Nice, well-defined trend line. And as I said, we already had yesterday or previously negative divergence on the S&P 500 futures here. So there's your divergence. That was a first divergent high right there. See the divergence lines. And correction one. We pushed to make a marginal new high, and it's still the same divergence. They just got extended even longer, bigger divergence. And we really had a little blip there, but it's not the divergences haven't played out. They just got larger until today. And now, just like the NASDAQ 100, the S&P 500 futures here on the 60-minute time frame popped that trend line. Again, gave us a little bull trap, I'm sorry. Popped the trend line right here briefly, and then a violent rejection below it, which was also a break of that short-term trend line. You can see those well on the intraday charts. That's really my go-to active trading time frame. So right here you can see beautiful little, this is a 10-minute chart, bearish rising wedge, negative divergence on the wedge. This is ES. You broke down, maybe it kind of looks a little bear flaggy right there. This little kick up here, I'll show you what I'm talking about. There it is, a little bear flaggish. But I'm going to say this, take this with a grain of salt. We're right in front of the FOMC meeting, so whether it plays out, I don't think it will. I think I see that and think it will, but that probably be a little too much. Again, volatility back and forth is usually what you get before an FOMC meeting. There are times you get a lot of profit taking and nervousness, but I think traders probably are seeing that as a bear flag, thinking it's going to play out to that next target down there, that support level, but we'll probably get a ramp up, and that's the way I'm betting it right now. NQ, show you that as well. NQ, step down to 10-minute chart, and there's what we have right there. Same thing, you had a nice little uptrend line. I can even step it down to a 5-minute and show you a little bit better here, I believe. Yeah, there you go. So you can see on the 5-minute chart, there was your uptrend line on NQ, negative divergence. That's what you like to see as a short-term trader, divergent high, and there was your breakdown sell signal. And that again all coincided with the failure back below that trend line, and that was a much bigger sell signal when the NQ broke out and then had an impulsive failure or reversal back down below the primary trend line. Again, you don't see it here on this little 5-minute chart. And so here's some little 5-minute divergence forming, and so we'll probably get a little bargain hunters step in that want to buy, and shorts that want to cover maybe today and get a little drift up. That would be my guess. All right. 12 minutes into that, a little more than I wanted to cover. Let me just rifle through the commodities. Again, this is what I call commodities as a whole, being one of the biggest thorns in the Fed's side right now. On one hand, they risk breaking the financial system. I've been for months now, almost backed off saying it because now everyone else is saying it. There was even a poll I saw on CNBC today, the risks of a financial systemic risk, systemic financial risk, something big breaking. And we already saw things break. We've seen things break in the UK and elsewhere, and again, but nothing major yet. And that risk was pretty darn high. I think it was like 60-something% said very high or high, and then maybe it was like 12-15%. Yeah, it was very high, and then 60-something odd percent was high, I think it was. Either way, it's that's a consent. And look, this isn't rocket science. If you've done this for a while, if you've been in the financial markets or studied the financial markets, things break. When too many important things move too fast, whether it's house prices back in the financial crisis back then, and the home prices tumbled, and then the banks had their, all those loans out there. It could be coming in financial institution failure, a country, a sovereign debt default, or something of the likes there. It can come in many fashions, and then of course everything's kind of intertwined, the global financial system. So one thing breaks in one place, it tends to have a domino effect because the whole financial system is leveraged to the hilt, and one thing breaks and then that breaks another, and which then breaks something else. Okay, all right, enough on that. Here's I'm going through this list. I have an ETF list of various commodities and commodity tracking ETFs and a basket. A lot of these are individual commodities, and I'm just going to go through quickly. BAL, cotton. I threw this one out as a trade idea too early in hindsight back there, but sometimes I can be stubborn on my long-term accounts if I'm feel something's going to eventually pan out, I'll give it more room. But most people should have probably stopped out on that one. But then I did mention it again recently here with this divergent low and a slight undercut. This is big support. And remember also, guys, we're looking at the ETN right here, BAL. These ETNs do a good but not perfect job of tracking commodity prices. They're basically a derivative of a derivative. And what that means is you have cotton, whatever it sells in the marketplace for, and then you have cotton futures, which will trade at usually a premium to the actual spot price. And then you have an ETN, in this case BAL, that tracks or holds invests into those futures to ultimately track the price of copper. So I guess in that aspect it's a derivative of a derivative. And so therefore it's not going to do a perfect job of tracking. But the gist is, and this is what I've maintained, think back 2009 when the market bottomed, the stock market, and we've been in a great bull since then, and how many times you look back, and myself included, where I've missed opportunities where I should have just loaded the boat on pullbacks, bought every pullback, every dip until the long-term indicators slip. Well, we have that opportunity again, at least I think we do, because by just about every metric that I have, commodities have just embarked relatively recently. Relative means a couple years into a new bull market, and that is because I go back and they're coming off a decade-long plus bear market, and every metric that I've showed you before shows the commodities have entered most likely a new bull market. And so therefore you want to buy the pullback, especially after the big corrections we just had. This is when the Fed, they pivoted too late. They were still dovish back here, keeping rates very low, telling you they were going to keep them low, and then this is around the end of the year is when Powell pivoted. And so what this is, institutions and traders, investors like me that were, saw this, nice run coming, started taking profits, got out. The risk reward was no longer favorable. You also had a buying climax in many securities. That means when you're going in an uptrend and all of a sudden things go near parabolic. So there were many signs that you're going to get a pullback, and you got it, and it was a pretty sharp correction. And so again, that was a combination of something going up a little too far, a little too fast, too many bulls, not enough bears, sentiment being high, etc., 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 coupled with the technicals, negative divergences, and everything else. They're all pointed out, all here. And so you had a correction. You had trend line breaks, divergent high, and you had a healthy correction. Then the traders bought it back up. Cotton there, that was a divergent low right there, a small divergent low was marked there. Nice rally, and now we have an even bigger divergent low. And you're also, again, on cotton, at least on this ETF, and the future, I showed you the futures before on this trade idea, you're now recovering that 53.60 level. So there's another, so far, if we can build on these gains today, that would be a bear trap, right? You have cotton bulls that threw away the long positions, got stopped out or gave up on a break below 53.60, and then if you recover it, then that gives you that what we call a bear trap, where the shorts pile in and then they get squeezed out. And so anyway, that still looks good. It still looks good up to those targets that I gave you before for a swing. And a longer-term investor that believes that we're in a new bull market for commodities may want to just ride out and just and swing for new highs, because a lot of these commodities will ultimately go on to make new highs, I believe. I think it's going to be a back and forth game of hot inflation, Fed getting aggressive, inflation abating, backing off a little bit. And again, I'm pointing out cotton. Cotton doesn't move the needles, but the same thing when you look at crude and natural gas and everything else. And then the Fed's going to think, okay, well, we can be a little more easy. We can let off the brakes a little bit, and then inflation's going to have another leg up, and then the stock market will have another leg down because the Fed has to then get more restrictive. So I think it's going to be a multi-year battle against inflation by the Fed, and that's just at the end of the day the casualties. One of the biggest casualties in that battle is going to be the equity market, the stock market. Okay, so there it is, trade idea. Take it, leave it. Maybe you're still in it. PALL, Palladium. This one's kind of when you take a step back and turn off all the lines. It's kind of in a big, grindy, sideways consolidation, a lot like gold. It's very similar to gold, and it is a precious metal. It's also, the main use is industrial metal, palladium, and emissions controls, palladium in the platinum groups of metals such as platinum, palladium, and rhodium. You can see it's kind of at that bottom of that support zone now. There's a downtrend line. Most recently put in a divergent high. So like everything else, I don't have a strong opinion here, but I can tell you we're at pretty decent support. That I can tell you. And there's a trend line right there. We do not have positive divergence. In fact, we're just coming off a divergent high, but the million-dollar question is that correction from that divergent high right here been enough to satisfy it, especially in a bull market. So I can tell you we're at support. The point of this video, I will do this. I will revisit these charts a little more detail, get a little more granular, go down to the 60 minutes and such. Some of these I'll give you in this video as trade ideas. This one I'm not sure. I'd have to really take a look at the futures and as well as the 60-minute charts of PALL. But I just want to point out it is at support and it's in a bull market, so you can make the case right there to buy. I just like a little bit stronger case. I like to see these divergent lows at support. That's all the better. In a bull market, forget about it. If I see security pulling back to a key support level or sometimes not even support, and you get these bullish divergences, positive divergences, especially with a trend line break, that's all you need in a bull market. In a bear market, you look for divergent highs, or even in a bull market, I'll look for the divergent highs to maybe take some profits and get out. But anyways, let's move on. That's just one of many, but it does have an impact on inflation, because that's one of the biggest. It's a big input cost to automakers. Is the platinum group of metals. That is. JJG grains. Well, okay, we're long wheat right now. This one, JJG, is a combination that holds the three big grains: corn, soybeans, and wheat. So you can buy this or you can buy those others. We did have, as I mentioned before, in a lot of things out there, we had a buying climax in a lot of commodities. It's been a bull run, and by the time it was about right here where the general public, your hairdresser and everybody, your yard guy, and everyone said, oh, well, I should be buying commodities now because it's inflation. Well, no, this is where we started buying them back here. We took this breakout of this bullish falling wedge. We were buying pullbacks to support. This is when you want to be taking profits and or selling, especially when things go vertical, parabolic. That is a blow off top buying climax. And then we had a pullback. But again, to me, that's not a buying climax to mark the end of a bull run, because if you go back in time, I can't go back that far because JJG wasn't trading then. We're coming off again we just came off a long-term bear market in commodities, and this is early stage bull market action. So it was a near-term buying climax. It happened around the beginning of the year. It sent the grains lower, but look, they felt a very good support right there. You had some divergences, positive divergence right there when they did, and they've been moving up. They're at resistance now, so would you be a buyer here? Well, it's not as objective, although we did, bought wheat right here the other day on Friday. That's when we had that long entry. And so if we can pop this, that's going to be bullish. And that's, again, an ETF that holds all three. I'll get to the other individual ones in a second. And I'm not going through these in any particular order. It's just how they are in my watch list, which is on another monitor that you can't see in this video. CPER, Copper Index Fund. I believe this one, if I'm not mistaken, you know what, I have to look it up. I can't recall if it tracks copper futures or a basket of copper stocks. You can look that up yourself, but regardless, you can see you had a big, it was a heck of a run like everything else since really since the COVID lows. Big bull market, and it put in a divergent high, negative divergence, but it's had a heck of a correction. And again, now you're not too far. You came all the way down. You have support here about 19, and the next support around 18. We already hit that 19. That may be it. And you have an uptrend line here. If you break the uptrend line, you still have the support around 19 and then 18. Either of those would be objective long entries, but you could also make a case here that we're in more of a symmetrical triangle pattern. If it can pop the top, it should run. Copper, is more of an industrial metal that, with my longer term outlook for a recession, near and intermediate term and longer term in the both the U.S. and abroad, that doesn't bode that well for copper. So I'm a little more selective on my commodities. Copper has obviously a big industrial use, and tends to go up and down with residential and commercial building due to the copper wires and everything they use it for. In the automotive industry as well to an extent. JJC, copper, another copper ETF, so no reason to expand on that one, just a different company there. USO, crude oil. Remember, crude peaked back here, and so we've had this abatement in inflation right there, and that gives the Fed a little bit of wiggle room there, a little bit of breathing room. The housing markets come down as well. So all this kind of plays into, I think, the fact that we had this rally in the stock market in the last few weeks here, especially with the positive bullish divergences. But you can see more recently, zoom in, crude's been going back up. So best I can tell right now, I have a downtrend line here, and I have this is very important, this uptrend line. I still have and maintain this target here, swing target of 56.80, and the primary uptrend line in crude. We came close but never quite hit it. So I'm leaning that way, still leaning that way, not married to it. And break of that trend line, and then this is a pretty big level, 78.41 is going to be bullish. And if this happens, just keep in mind, whether you're trading crude or not, that's no bueno for the stock market. That just continues to tie the Fed's hands and forces them to keep the brakes on and keep raising rates to try to stop the rate of inflation. This is just going to cripple more so a lot of European countries, and but it's not good for the U.S. either. But we got to keep energy prices down, or the inflation trade's just going to rage on. So watch it, and again, maybe in a separate video, or I'll follow up with some post of individual charts, either under this video and this post on the homepage in the comment section, or maybe some follow-up posts with some trade ideas. I didn't have time to look at each and every chart and tell you whether this is a buy or a sell right now. I just wanted to kind of give you the overall bigger picture of what's going on in the commodities arena here. PPLT, this is platinum ETF, and there's a nice downtrend right there. You put in a divergent low recently at support, big support by the way, and now we're at trendline resistance with price resistance overhead. So really, if it can pop 90, it should run up there to 96, and then potentially up to about 100 and change there. Otherwise, you get rejected. If it comes down, you want to watch this trend line. If we were to break the support anytime soon, you're still going to have positive divergence. So I wouldn't short it. I would look for a reversal back above to buy it if we get a false breakdown, whipsaw. Otherwise, right now it's at support. And again, I would have to dig down into the shorter term charts. That's not the point of this video on each and every one. Say, oh, well, okay, look, we're at resistance of that downtrend line with negative divergence. So if I had to bet one of the two, I'd say probably be able to pull back off that trend line because we have negative divergence here. But again, I'd want to look at the futures as well, not just this ETF. LD, lead, this very thinly traded, and I don't have much of an opinion on that, just other than that, this is about when most commodities peaked, and we've had an abatement, which again is probably why the market's expecting the Fed, and myself included, I'm expecting the Fed to back off, if nothing else, more so the fact they know. I mean, obviously I'm not a big fan of Powell and or the Fed. I'm one of their biggest critics, but I think as clueless as they were and still are, I think in a lot of aspects, they have to know what I'm saying. They're going to break things. They're going to break the financial system if they keep going up. So this gives them room, a lot of things having come down recently off their highs, including crude oil and natural gas, gives them a little room to say, hey, all right, we're going to step back. We've done a lot. We'll watch, wait and see, and we'll decide in December whether we need to make another rate hike or just sit tight. That's probably the route they're going to go to some degree or another. Tomorrow, I'm talking when Powell speaks after we get the 3/4 point hike that the market's expecting. Oil K, that's just a K1 free ETF. So USO is a ETN. You get a K1. Some people don't like those K1s. They come out usually late, but that's that support right there. And again, it's not tracking the price of oil as well as USO in my opinion, but that's what it looks like. Big support right there, bearish if that goes on that one. But I would urge you to really pay more attention to WTIC, West Texas Intermediate Crude. You can get those charts on stockcharts.com for free, or use CL. Your broker will probably give you free futures quotes. CL's the crude futures contract. UGA, this is unleaded gasoline. So you can see here, just about everything has peaked. Gas prices have peaked and have been falling. You had a trend line break after the divergent high, which was a sell signal, but you came and you hit some support here and you bounced. And in a bull market, that might be all you get off that divergent high. I don't know. I don't have a strong opinion on this. I would have to study gas futures and let you know. But if it breaks, there's your next support, 43.90, and then support down here. Either way, we can see you had an abatement, but then recently we're ticking back up on gas prices and oil as well. So that in itself is going to be, it's a little bit of a thorn in the side for the Fed. And I'm talking right here, that's what is that, about last month or so right here? Since about end of September, really about here, we bottomed about early September, and then did a double bottom there September 23rd, and we've seen gas prices moving steadily higher since. Nothing runaway or anything like that, but still that definitely plays into inflation and forces the Fed's hand a little bit there. Wood, this is not the price of lumber. It's an ETF that holds timber and forestry companies. And that one just hit support recently, overshot it briefly, and is above it. I can't make a screaming case to buy, but longer term, I think this one is one that you might consider to hold in your portfolio for commodities play. Even though these are individual companies, that's the problem. If the stock market goes into sell-off mode, especially a hard sell-off, individual stocks, such as gold mining stocks, tend to get sold down even if the price of gold holds up or even moves up. Sometimes I've seen that happen where the gold mining stocks get sold down, or the timber and forestry stocks, just for the simple fact that they are stocks, they're equities, and some of these may be in the S&P 500 in this ETF. Cane is sugar. Sugar's actually looking good. Here's another example. When you look at this one, I know it's kind of busy. Remember, sugar, like everything else and most commodities, we've been in a bear market. We had bear market rallies. We gained some of those. I can see my previous trades on there. And then boom, right when COVID hit, the bear market in commodities ended. And again, it was a long-term bear market. All the while, the stock market was in a bull market up until then. Since then, you can see it's been a nice advance. We had a inverse head and shoulders pattern. I pointed out at the bottom, that was the head, left shoulder, right shoulder. There was our neckline right here. There was the breakout, and it never looked back. And remember, inverse head and shoulders, as I would have pointed out at the time, are bottoming patterns. They're not short-term trading patterns. They mark the end of a bear market or end of a downtrend, primary downtrend, and the beginning of a new uptrend. That's why they call it a reversal or bottoming pattern. And sure enough, it was. Look at that. Now, we've come full circle. It's been a heck of a run. But, like everything, you get a little overextended. We put in a divergent high right here, i.e. negative divergence. You can see it all the way there on the indicators if I draw the lines like that. And then you took out this trend line here, and you've had a correction. Now, again, in a bull market, I don't, that certainly makes a case for a correction, but not necessarily the end of the bull market. In fact, again, when I go to the longer term charts, which I haven't done here, weekly and even monthly charts, this to me looks like early stage bull market action. So this is a correction. You can see we've kind of been consolidating in this range right here. So ultimately, an upside break of that range, it's going to be bullish for sugar. Obviously a downside break, but look what happened. We already had support here. We broke it ever so slightly, but we put in positive divergence recently. See that? At the low. So now we're moving up. If we can pop this downtrend line, bingo. That should be a buy signal for sugar. Should send us probably to the top of the range and quite possibly and ultimately beyond. I don't know if this time around, but maybe. So that's a trade idea for you. I'm going to give you SGG in a second, and let me just give you, because this is one trade idea I wanted to share for you. SB, it's a little overextended near term now, but this is my 6-month chart of sugar futures. SB, let me make sure it's up to date. You have a downtrend line right there. You had a nice symmetrical triangle pattern right here, and you can see it broke out. We had a breakout, and it ran hard, just like it did here, and it put in a divergent high like it did back then. Divergent high had a correction. Put in a divergent high, and it also had a correction. But this time around, look where it corrected to. See the triangle? I extend that line. Beautiful. And I wish I would have seen it here and pointed it out to you. I would have taken it myself. So I'm watching this one. I don't know if it's going to let me in, but I'd like to see a pullback. But that's bullish price action. Look at that. Look how impulsive that is. This is bull market action. You got a pretty good correction, and the buyers are stepping in here. And again, I showed you what it looks like on the charts of Kane. I'll get to SBB or SGG in a second. That's the other sugar ETF. If I didn't already cover that, let me see. Where is that little bugger? I'm looking at my list on another. Okay, it's down a little lower. You know what? I'll jump over to it. Just some more on that. It's just a different company's ETF, ETN, excuse me, to be technical. ETN, not an ETF. And it's been kind of consolidating in this bull market. I believe to be bull market consolidation with ultimately an upside break to come. However, a downside break is going to be bearish, and there's an uptrend line which we just bounced off. That's that same exact uptrend line I just showed you on SB, the sugar futures, and so we're moving higher, and we may just continue higher. You know, these commodities, when they want to run, they can really run. So I might even end up jumping in there and just take a starter position. That's what I like to scale in, especially if I don't. When I have a hard entry is if I get a pullback to a very well-defined support level, and especially if I have positive divergences when it does that, then I make a hard entry. That means, let's say I want 50,000 in sugar. I'll put in 50,000 right there, and that's it. I don't add to it. But if I want, 50,000, but I've missed that entry, I might 10,000, and then 10, keep scaling in. I'll scale in on strength or weakness. So that to right now it'd be more of a scale in because I missed that optimal entry recently. But again, this would probably be an all-in moment once we clear the top of this range, if the charts confirm at the time. All right, next one up would have been, I have to jump back to my list here. Cut is just another timber and forestry company ETF. Again, you can see kind of pulling back to support here. I'm not crazy about the chart right now. I'd have to study a little further, and I'd also have to study the components of there. That means you go in there and you look, these are the components. SAP, there was a nice divergent low right there. Nope, SAP is technology. I don't know why it was in the, I loaded the component list. Sometimes this charting platform will mess up and they'll put a stock that shouldn't be in there. This one is Weyerhaeuser, AMC, no, yeah, packaging and containers. That's in that ETF there. Avery Dennison, the paper you buy for your printer, international paper, because they have forests, they have trees that cut down from paper and packaging companies, cardboard packaging and the likes. And then some of these are, a lot of these are packaging companies. And when you go to that other one I had, which one was that? Cut. And you go to wood. Here you can see the same thing. International Paper, Westrock Company, Rainier, all these different REITs, and maybe they own forestry, I don't know, timber companies. What I like to do, I guess, guys, my point is I like to look at all the components, because I always say an index or a sector or a sector ETF is simply a sum of its parts. And there are some indexes and some sectors that have very high correlation among all their components, like GDX. I've gone through the components of GDX thousands of times over the years, and rarely will you see I've never seen an eclectic mix of bullish and bearish charts. They're either all bullish, putting in divergent lows and coming down to support or breaking out of bullish chart pattern, or they're all bearish, or sometimes indeterminable. I don't always look at a chart and see a bullish or a bearish setup. This one, to me, for example, is indeterminable. I don't see a move here. This thing's bouncing around. But back here, I could tell you, oh yeah, if I would have saw that company then, that divergent high right there, trend line already broke the first one, had a little pullback, then came and took that second trend line right there. Yeah, that was a clearly bearish chart, and that was bullish right there when it set up the divergent low right before the big rally. So right now, nothing. So what I'm getting at here is when I go through these components, these individual stocks, aren't always in sync like the gold miners, and that's why to get comfortable to go into wood or cut, I want to see the majority of those looking bullish, making a case to go into it. Like this one here, a little divergent low right there. Well, not really, because you took in a lower low there and you didn't hit that support level. I would have rather seen it come down to that next support. Almost done here, and next we'd have GSG, just a broad-based commodity index fund, divergent high, little wedge right there, but see, here's bull market action. So you had a primary bull market uptrend line right there, put in a divergent high, got ahead of itself, corrected, but then recently you put in a divergent low, right? And you're in a bull market, so you've been moved up, you back tested the trend line. Ultimately, if it can regain that trend line and then take out the highs, that's going to be bullish. If not, maybe a little more downside, and maybe it'll keep that divergence intact and hit this uptrend line there and that 1823 support. I'd be really interested there. So, and watch these broad-based commodity index. These are what I call my real-time inflation indicators, particularly this one. This is the one I kind of, no, was it this one? GCC? No, this one. This is one of the ones I was using. This one did something funky recently. I don't know, some kind of split adjustment, dividend payout. The candles are all down here in a cluster, and that's not. I have to look in to see what happened there with GCC. That I don't know. It's not natural to have it drop like that. It's either some kind of adjustment in their shares, some kind of split, or big distribution that they might have made. GLD, you guys know my thoughts. I've covered it quite a bit lately. I'm liking it, but to really love it, I need to see it regain 158 right there. Big support, or now resistance level. And the divergences tell me that's likely, and especially the charts of the euro and the US dollar, which I've covered quite a bit recently in other videos, so I'm not going to go there right now. Soybeans, look at this. Here's another, and one of the grains, divergent low, pointed out at the time there was a buy signal on that break there, big divergence building at the end. That was the end of the bear market, beginning of a new bull. Ran up, nothing goes up forever. You can watch these little trend lines, look for the divergent highs that say, hey, maybe book some profits if you're a trend trader. Breakdown back test, and there was a correction, but then that correction set up with a beautiful bullish falling wedge, and that's what you want to see in a bull market. So the corrections you see how aren't as big as the preceding rallies. This is bull market action. Divergent high only leads to correction, which then set up in a bullish wedge and then broke out. Again, you put in a divergent high. Nothing goes up forever, even in a bull market, and you had negative divergence. You had another correction, but that correction took us back to uptrend line support, and now you have, if I just take away everything else, you have a downtrend line and an uptrend line. That's a symmetrical triangle pattern. Pop above there is going to be bullish, pop below will be bearish. However, in a bull market, you just look for pullbacks to these supports as potential long entries, and if you can align that with positive divergence or anything else, great, all the better. Okay, I'm going to rifle through these a little quicker. Video's going long. There's my go-to commodity, real-time commodity ETF, DJP, the one I've been using for a while here. Little triangle pattern there as well, descending triangle pattern. Back here we put in a divergent high, and I gave you a price target down here. We're close, and we may hit it, maybe not. If we do, I think it's a buy, $31. However, we're at support right now. We've been holding. We've got about a triple bottom there, at least 3 equal lows right there so far. If we can break above, that's going to be bullish. If we have another thrust down, great, I'll buy it, because not necessarily. I like to select my individual commodities. This is just kind of a broad base, and if you don't have the time or the skill sets to manage, a portfolio of individual commodities, this one's perfect, because you got exposure to everything. And so you can see if we get a little punch down through there, it's going to give us a divergent low if it happens anytime soon, and that would give us also this little bullish falling wedge right down to support. I'd buy the bottom of the wedge, even a brief overshoot, especially recover back above, and then I'd add to it on a breakout above the wedge there. MOO is an ETF that holds agribusiness. This holds equities. It doesn't hold cows, live cattle, doesn't hold milk, dairy cattle, or anything like that. It holds John Deere and Archer Daniel Midland, those type of companies that are in the ag business. Put in a divergent low recently. It's got a downtrend line that could pop there. Hard to see it run too hard if the stock market falls, but if the stock market rallies, then this sector looks as good as any right now, especially on a breakout above that wedge there. DBA, well diversified ag ETF. It holds cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, cattle, lean hogs, feeder cattle, cotton. You got it. Just about everything in there. At support, downtrend line in which to trigger a buy signal, so you can go long at support. Positive divergence at this recent low. So it's objective long here and objective long entry or add on a breakout above there. First target 2135, takes that out. It's probably going to new highs after that. If it happens to fall down below here, well, my next support, decent support, is down there all the way at about 1764. And believe me, in no way would that eliminate the bullish action, the bull market in this thing. You can go back for a long time in this one. You can see this bear market in commodities. This was back in 2008. During the financial crisis, and commodities have been in a vicious bear market since, down about 70%. All the while the stock market was going up, which is unusual because usually commodities go in line with the stock market because they're economic growth. You have a higher demand for commodities. There's more building, construction, consumption, gasoline, but this was unusual. So you have a valuation. This is what I was harping on a couple years ago. If you guys remember, it wasn't just the technicals. I said from a valuation perspective, I was putting a lot of my money in commodities because corn does not declare Chapter 11 bankruptcy. It doesn't have a CEO doing some shady, scandal, or the company's not cooking the books. There's always going to be a demand for corn and wheat and soybeans and things like that. And so, to me, the fundamental case was screaming to buy commodities. And the technical case was just as strong, and boom, and again by just about every metric, meaning taking out all those previous highs, that says a bear market ended there, and this is early stage bull market action. And even if we're just going back, we're in a hyperinflationary environment right now. We're in inflation hasn't been this hot in over 40 years. So to think, is it unreasonable to think that commodities are just going to go back to where they were in 2008? I mean, and that's just 2008. So I think that's an easy target, the previous bull market high, and quite possibly beyond that. So in other words, I see a lot more upside in commodities, and until the charts convince me otherwise, I'm going to be looking and highlighting opportunities to buy the dips back to support on these in these corrections, what I consider bull market corrections. Okay, yeah, I probably shouldn't have done the equities in the beginning. We're on 1, 2, 3, 4. I got about 10 more to cover. I'll run through them fast. Wheat. All right, you already know wheat. No reason to update that. I threw that as a trade idea on Friday. Some volatility over the weekend with the Russia saying they're not going to honor their pact of safe passage to the ships taking grain out of the Black Sea, but then the ships are running anyway, so it was a pullback. I mentioned that was a buying opportunity, that pullback, because people are trading on the news. Well, nothing changed technically. We bought this on the technicals, and so anyways, that trade still looks good. Wheat's up again today, so we bought it here on Friday on the trend line, 2 days green candles. And again, long-term trade, this is in a bull market. What you want to do is, I don't want to say tuck it away. You always want to use stops, not let anything get out of control. But in a bull market, buying pullbacks to uptrend lines is a gift. That's usually the road to new highs when you do that. So longer-term traders can just, hold it for a while as long as it looks good. Corn's the other big grain. There's a downtrend line. If it pops that, it's going to be bullish. Last time I highlighted corn as a trade idea was right here on that divergent low, and we hit that first target. I think I only gave you one target, I guess, at the time, but it needs to pop that trend line. That looks good. And again, bull market corrections probably going a lot higher in the coming years, at least the coming year or so. Coffee is another one I bought today. Nice support right here on JO. It just hit. JO is a coffee ETN. Let me show you KC, the coffee futures. That's what I went with. KC, this is a 3-month chart, hourly chart. You just put in, I don't know why my line moved, but I had a positive divergence line right there. Divergence. Little trend line break here, a little breakout and back test. But coffee coming off support. Small. I took one starter position. I'll probably continue to add to this. And there's another trade idea for you. Cows, a livestock ETN, lean hogs, live cattle, that kind of stuff. Really just kind of bouncing around, going nowhere, near resistance. But again, overall in a bull market, cattle prices and livestock prices have been moving up because we're in a bull market. So maybe a pop over there. I'm just not crazy about it. Plus, I always like to trade cattle and hogs on their own technicals using the futures. This holds both, and sometimes one's going up, the other's going down. So I'm not a big fan of cow. SGG is the other sugar ETN. I think I already covered that for you. Yes, I did. JJS is the Bloomberg soft. Here's an ETN, ETN that holds soft commodities, which are in this case coffee, cotton, and sugar. Pulled back to support recently. Again, nice run up, divergent high. Nothing goes up forever. There's your primary uptrend line, broke, back test, correction. And I like it here at 54.28, and if it goes lower, I like it even better there at 51.14 or so. Probably get a bounce here, run up there, and then ultimately head on up and take out those previous highs. And again, worst case scenario, well, not worst case, but again, if it goes down to 51 and the charts confirm it'd be a buy. There's aluminum looking nice here. Look at that. Well, a little paradox, but maybe it means the economy is going to pick up, or whatever reason aluminum prices are going up. There's a nice divergent low, JJU. Recently took out this support level, so it needs to take that back, 49, because then you'd have this whole thing here would be a bear trap. That would be bullish. Otherwise, you don't take a security just below support, even though you have positive divergence. You'd want to see this level get taken out. Then I'd also have to look at the futures. Cocoa, NIB, nice divergent low here, positive divergence you can see, and it's at support. We had we're buying it back here. You can see we're just swing trading it. T1 hit, T2 hit, and then we bought it again. T1 hit, T2 hit. We kept buying and selling it there. And then I had longer term targets. Then I shorted it here. I guess potential target zone was hit. Yeah, that was my long-term target zone from all the way down here. Hit it to the button. We shorted it. T1 hit on the pullback. T2 hit. I guess that was the final target. And it's just been this little sucker. It looks like an EKG. If you just look at these trends, it just goes in these rips and dips. And lately it's been going down, but it's at support and has positive divergence and just broke out. So CC or your cocoa futures needs to take out this downtrend line right here, but you're coming off a divergent low right here, so your positive divergence on the 120 minute chart, 2-hour candles. So it's got a minor support right here, or resistance at 23, what is that, 23.52, and then a downtrend line. If it can pop that, this sucker should run. You get a reaction high there to clear. And you can also look at it as maybe a longer term investment. If you agree with me that we're in a commodities bull market, this is when you want to buy cocoa on a pullback like this. There's a weekly chart, took out that trend line, but we're still above. There is some support here, and we're still above the low. So cocoa's been one of the weaker commodities. Everything else is way up here after bottoming. But again, we're looking at this one bottomed back in 2017, and it's back near those lows. So I'm not crazy about it, but just throwing it out there as another potential investment opportunity. All right, that is it. Other than natural gas, I've covered this one quite a bit recently. It's just been a trading vehicle for me lately. Support around 1773, and PPO is starting to turn up here, and you may get some divergence there on the PPO. I'd have to look, and I actually have been trading it today. You can look at the not the January. Let me look at the December. I've got a contract here. There it is, December chart. This is you can see here we have this uptrend line that broke recently, sent it down. You've got another support level right here, previous reaction low. We undercut this level today, 726. Very steep downtrend line right now, but on this 5-minute chart, let's see, look at that real quick. 5-minute candles. Looking like you still have this divergence here on the PPO, no RSI divergence yet. Very steep uptrend line, so that's what you need. Pop that trend line, you're going to have a quick trade, long side trade, and I would say I'd have to sharpen my pencil, but probably up to about right here. I'd say that one would run up to right about there. 5.809, so call it 580 right there if that trend line pops soon. Okay, super long video, but I covered a lot. And again, Fed's up on deck tomorrow, so just going to be choppy until then. There's some day trading ops to be made, and that's probably about it. And then once the Fed's out of the way, we'll have a good idea whether this market wants to clear those trend lines on the 60-minute charts of NQ and ES. And it's not ES and NQ only. You can look at SPY. I know I cover the futures. But if you're a SPY trader, you can see it on the 60-minute chart as well. We have that bearish rising wedge pattern, and it's pre-Fed. We're just below it. It looks like a little breakdown there, but you take that with a grain of salt right in front of the Fed meeting. It does have that bearish bear flag looking shape, and maybe that will play out before the Fed. I don't know if there's a lot of profit taken. If it does, then you're going to have a solid and confirmed breakdown of this 60-minute bearish rising wedge pattern, complete with the negative divergences. Otherwise, that could prove to be a whipsaw. And again, we'll know tomorrow. So I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.